Hello and welcome back to Boss Economics World, the only show that peels back the glossy veneer of global finance to reveal the beautiful, tragic comedy underneath. To my dear friends, my seasoned professionals, and of course, my cherished Jukais, ready for the next harvest, grab your coffee, or perhaps something stronger, because today we are dissecting a statistical magic trick so audacious, so profound, it makes David Copperfield look like a street performer. The date is September 10, 2025. And the U.S. Bureau of Labor Statistics, the supposed high priests of economic data, have just pulled the rug out from under the entire market. They've revealed that the vibrant, robust American job market we've been hearing about for the last year was, in fact, partially a mirage. A ghost army of 911,000 workers has simply vanished. Poof. Gone. This isn't just a rounding error, my friends. This is the largest downward revision in the history of the Republic. It's like finding out the star quarterback you've been cheering for all season was actually just a hologram projected onto the field. And now, everyone, from Jerome Powell at the Fed to the furious spin doctors in the White House, is scrambling to figure out what this phantom economy means for our reality. So, let's dive into this statistical black hole. We'll go from the point, the shocking number itself, to the surface, exploring the crumbling credibility of our economic compass, the Fed's glorious excuse to fire up the money printers, and what this all means for your portfolio, your job, and your sanity. Let's start with the headline that sent tremors through Wall Street, a preliminary benchmark revision suggesting that from March 2024 to March 2025, the U.S. economy created 911,000 fewer jobs than we were told. To put this in perspective, the original data suggested a respectable, if cooling, average of 149,000 new jobs per month. The revision slashes that number in half, to a paltry 74,500. This isn't a slowdown, it's hitting the emergency brake while looking in the rearview mirror. The economy wasn't jogging, it was limping and covering it up with a statistical limp. Think about it this way, 911,000 jobs is roughly the entire workforce of a city like San Jose, California. It's as if one of the core engines of Silicon Valley just disappeared from the national accounting, and the accountants only noticed a year later during a routine audit. The downward revisions were not isolated. They were systemic. Wholesale and retail? Vaporized jobs. Leisure and hospitality, the supposed titan of the post-pandemic recovery? A significant portion of its workforce turned out to be statistical ghosts. Professional and business services, manufacturing, all marked down. It's a broad-based evaporation of economic activity that we were all trading on. This revelation serves as the perfect catalyst for the Federal Reserve. For months, Jerome Powell has been walking a tightrope, trying to project strength and resolve against an inflation rate that, while down from its 2022 to 2023 peaks, has remained stubbornly sticky, hovering around 3.2% for the first half of 2025. He's been the stern father threatening to take away the cheap money punch bowl. But now? This report is his get-out-of-jail-free card. With job growth revealed to be so anemic, the risk of over-tightening and tipping the economy into a deep recession becomes the dominant narrative. The dual mandate of the Fed is price stability and maximum employment. With one of those pillars now revealed to be made of styrofoam, Powell has all the political and economic cover he needs to do what the market has been begging for: cut interest rates. Traders are now pricing in a near 100% certainty of a 25 basis point cut at the September 17 meeting. The debate is no longer if they will cut, but how deep the cutting cycle will be. Will this be the first of 3 cuts before year-end? 4. The floodgates are creaking open. As BMO Salguatieri put it, this gives the Fed another reason to lower rates. Another reason is polite economists speak for a golden, undeniable, politically bulletproof excuse. Now, let's zoom out from the immediate market reaction and look at the more corrosive, long-term damage. This isn't just about a number. It's about the sanctity of the numbers themselves. In the 21st century, economic data is not just information, it is power. It moves trillions of dollars, dictates national policy, and determines elections. And right now, the very institution responsible for that data is under a political siege. The Trump administration, never shy about a brawl, has seized on this revision with predictable glee. The White House press secretary declared it proof that Biden's economy was a disaster and the BLS is broken. The new labor secretary, Lori Chavez DeRemer, called it an unacceptable error, questioning the integrity of data. Of course, this is pure political theater, but it lands punches because it taps into a growing public distrust of institutions. Let's be brutally honest, this isn't a one-off. The 2024 preliminary benchmark was also a massive downward revision, the largest since the 2009 financial crisis. We are seeing a pattern of initial, rosy estimates being quietly walked back months later. This creates a dangerous dynamic. The initial, stronger number dominates the news cycle, shaping public perception and policy debates for months. The subsequent, much weaker revision is a footnote for financial nerds like us. It's a classic case of print the legend. A government can benefit from an optimistic narrative in the short term, even if it's eventually proven to be a fantasy. But why is the data so wrong? Why are these revisions getting bigger? Let's put on our forensic accountant hats. The BLS uses 2 main surveys. 1. The Current Establishment Survey, CES. This is the monthly payrolls number. It's a survey of about 122,000 businesses and government agencies. It's fast, but it's a sample. 2. The Quarterly Census of Employment and Wages, QCEW. This is the benchmark. It's not a survey, it's a near census based on state unemployment insurance tax records, covering 95% of U.S. jobs. It's incredibly accurate, but it's slow. The data we are getting now is for a period that ended 6 months ago. The annual revision is the process of truing up the fast CES data with an accurate QCEW data. The widening gap between the 2 points to fundamental cracks in how we measure the modern economy. Crack number 1, the broken birth-death model. To account for new businesses being born and old ones dying, the BLS uses a statistical model to estimate this churn. However, in the chaotic post-pandemic economy defined by the Great Resignation, the rise of solo entrepreneurs, the gig economy, and rapid-fire tech startup creations and implosions, this model seems completely out of its depth. It was designed for a 20th century economy of stable, long-term employers. Today, it appears to be overestimating business creation, leading to these inflated initial job numbers. It's like trying to count a swarm of bees with a fishing net. Crack number 2, the Schrodinger's immigrant worker. This is the elephant in the room. The initial CES survey might pick up workers, including unauthorized immigrants, who are on a company's payroll. However, the QCEW is based on unemployment insurance records. Unauthorized immigrants are not eligible for these benefits and are therefore far less likely to appear in this more accurate census. This could mean that hundreds of thousands of jobs, particularly in sectors like construction and hospitality, exist in the real economy and the initial survey, but vanish in the official, final count. They are both employed and uncounted, a quantum state of labor that completely befuddles our official statistics. This isn't just a data problem, it's a profound statement about the growing disconnect between the official, taxable economy and the vast, gray economy that powers so much of America. So, when the White House screams about the BLS being broken, they are cynically exploiting a real, underlying issue. Our primary tool for measuring the economy is struggling to capture the economy itself. We are flying a 747 with a dashboard from a Cessna, and the turbulence is picking up. Now, for the professionals in the room, let's talk about the real game being played. This data revision, while embarrassing for the BLS and politically explosive, is a shot of pure adrenaline for the financial markets. Welcome to the bizarro world of post-2008 finance, where the underlying principle is simple: bad news for the real economy is good news for asset prices. A strong economy, robust job growth, and healthy wage increases? That's terrifying. It means the Fed has to stay hawkish, keeping interest rates high to fight inflation. Higher rates make borrowing expensive, reduce corporate profits, and offer a safe, attractive alternative, bonds, to the casino of the stock market. But a weak economy? A phantom army of 911,000 jobs disappearing? Oh, that's beautiful. That's music to Wall Street's ears. It means the Fed has to pivot. It means the Fed put his back on the table. It means the cheap money spigot is about to be cranked open, flooding the system with liquidity. This liquidity doesn't necessarily create new, sustainable jobs or fix underlying economic weaknesses. But it does one thing with remarkable efficiency: it inflates the prices of financial assets. Stocks, crypto, real estate, venture capital, everything goes up when money is cheap. This is the great addiction of the 21st century market. It is no longer driven by fundamentals like productivity, innovation, or corporate earnings. It is driven by the anticipated actions of a handful of people on the Federal Open Market Committee. The entire ecosystem is geared towards predicting and front-running the Fed's next move. The S&P 500 fluctuated on the news, not because investors were confused, but because they were rapidly recalculating. The negative of a weaker economy was being weighed against the massive positive of impending rate cuts. In the end, the liquidity always wins. Expect to see a rotation. Cyclical stocks that depend on a strong economy might suffer, but the long-duration growth stocks, the tech darlings who live and die by low interest rates, will likely soar. The Nasdaq will be the primary beneficiary of the BLS's statistical blunder. Bond investors are already celebrating. Treasury yields, which move opposite to price, are falling across the curve. The 10-year Treasury, which had been stubbornly resisting a move below 4% in 2025, is now on a clear path downward. The bond kings are back in business. So, what is the takeaway for you, the citizen, the investor, the professional trying to make sense of it all? First, recognize that we are operating in a hall of mirrors. The official data is a flawed, delayed, and politicized reflection of reality. The initial numbers are a first draft of history, and the final revisions often tell a completely different story. As an investor, you must learn to trade the narrative, but trust the revisions. Be deeply skeptical of any single data point. Second, understand the Pavlovian relationship between the economy and the markets. The bell rings, bad economic data, and the market salivates in anticipation of Fed easing. This is the unhealthy, codependent relationship that now defines modern capitalism. Your investment strategy must account for this paradox. Sometimes, you have to cheer for bad news if you want your portfolio to go up. It's perverse, but it's the reality of our monetary age. Third, prepare for a new wave of liquidity. The rate cuts are coming. This will likely put a floor under the stock market and reignite speculative fervor. But it also means your cash in the bank will earn you nothing. It will push you further out on the risk curve to seek returns, whether you want to or not. The Fed isn't just cutting rates, it's forcing you to gamble. This 911,000 job revision is more than just a number. It is a symptom of a deeper malaise. It's a crisis of measurement, a crisis of political trust, and a stark reminder that our financial markets are hooked on the drug of central bank intervention. We've built a global economic superstructure on a foundation of data that we now know is deeply flawed, and it's being steered by a pilot who has just been handed a faulty map. As we sail into the uncertainty of late 2025, with the promise of cheap money dangling before us like a carrot, ask yourself this: are you building your financial future on the solid ground of real economic value, or on a statistical illusion that could be revised away in the blink of an eye? Think about it. This has been Boss Economics World. Stay cynical and stay ahead.